The new data just came out this morning, so let's take a look at what's going on. In order to do a good job of evaluating the market, we need enough data to be statistically relevant and give us a clear picture. So we're going to take a look at all of Fairfield County. Let's go. Hi, if you're new to the channel, my name's Vinci. I'm a realtor covering the Gold Coast area of Fairfield County, Connecticut. There's a ton of information on this channel and on my website. I'm going to leave a link on the screen and below the video. Let's jump right into it. There will always be sales of homes, no matter the market conditions. Simply put, people need places to raise their family in a safe and secure environment, and no market force is going to trump a family's true need for shelter. No matter how you time it, there will be competition for good homes. Even in one of the worst real estate crashes in recent history, one that has no resemblance to our current market metrics, by the way, in the worst 5 years after the 2008 crash, we still sold an average of 976 homes in June. The annual sales peak typically happens in June or July, and over the last 20 years, we typically sell about 1,250 homes in the peak month. And that's factoring the worst 5 years that I previously mentioned. This year, our peak came in June, and we hit right in at 1,275 sales, or roughly what we would expect from a historical perspective. This might come as a surprise, so let me add a little bit more color. Listing prices aren't likely to go down significantly. Here's why. While we will see a drop in average or median prices, this will happen because the crazy over-asking offers from the spring are subsiding and homes are beginning to sell closer to their listing price. This one factor alone could equate to a 10% reduction in some price brackets. While this is great news for buyers, you may not actually notice a 10% reduction in asking prices. As a buyer, it's going to look and feel a bit different due to the limited supply. This graph shows how long it would take for us to sell off all of the inventory we have if no new inventory came on. It's essentially a ratio of how fast homes historically sell and in relation to how much inventory we have. It's our best indicator for a tightening or loosening market. But this isn't the whole picture. If you find yourself frustrated about the low inventory, I'd like to remind you that we sold 1,275 homes in June, which is pretty typical from a historical perspective. So what's actually happening? This graph shows the days a home was on the market over the last 2 decades. As you can see, homes are moving very fast now, and that's the reason that the months of supply are staying so low. Buyers who move quickly are getting the houses. If you find yourself unable to move quickly, it's likely because you're afraid of overpaying. While a good realtor can help you with this, I want to highly encourage you to watch the sold market data. You can do this on our website by creating a custom market report. I'll leave a link below in the description, or better yet, email me and I'd be happy to create a specific report that delivers you the sold properties that are similar to what you're looking to purchase. I'm happy to help you, no strings attached. By the way, the buyers who get these homes are typically viewing the property in the first few days on the market, so it's not so much that there's low inventory, but that you need to be able to move quicker than you would have had to in the past. Let's go back to the months of supply graph for a moment. I wanted to point out that I have done the research over all of the price brackets, and this trend is consistent even in our ultra luxury market over 5 million, which historically has had years of supply. It's way down and selling much better. All right, I have a warning for you. I'm going to be bold here. If you think we're going back to pre-COVID pricing, you're probably telling yourself the story that you want to hear, a story that the data unfortunately does not support. Take a look at the median sales price graph for the last 2 decades. Do you see how far prices would have to fall? It's pretty difficult for this to happen with historically low inventory. While we're talking about price, I thought you'd like to know that the peaks generally correlate with the peak sales month of June and July, because higher priced homes sell a bit better in the spring, and the competition of the spring market tends to bring higher prices. Historically, if you want a good deal, it's more likely to happen in the fall and early winter. Take a look at the months of supply graph again. Look how long it's taken for us to get here. One way to see how strong a market is to look at how much buyers are paying relative to asking price. Historically, since our last recovery, the average hovered around 97% of asking price. That shot up after the COVID shutdown, and by December of 2020, we hit 100% of asking price across the entire county. It has pretty much been between 99% and 104% since then. In reality, great homes went way over asking, while less desirable properties sold under the asking price. And of course, those numbers are the average between the two. Even though we're down from our spring peak of 104%, we are still at a median of over 100%. This is obviously an indicator of a strong market. You can take a look at our last market boom on the left side of the graph between 2003 and 2005, when we peaked at around 98.5%. Interestingly, if you remember from our median sales price graph, the median sales price didn't peak in that last boom until 2008, nearly 3 years after the peak list to sale price ratio peaked. My point is, even if buyers start paying under asking price on average, it could be years before we see a reduction in average sales price. And the sources that I trust are not predicting a recession similar to the historical decline of 2008. Most think that this will be a relatively shorter recession. Considering the low inventory, it's entirely possible that we can ride this one out with any major reduction in median sales price. If you're a buyer, yes, the inventory is low, but there's no point in getting frustrated about it when you can choose a savvy agent and be better prepared to pull the trigger by staying on top of the sold data or relying on your trusted realtor for that information. Even though the risk is minimal, you should hedge against it by buying for the long term and continuing to own real estate for the duration of your life, even if you trade up. You may win some, you may lose some, but overall, history tells us that you will come out ahead. This isn't like the past real estate busts. In the mid-80s bust, interest rates were sky high. I know many people who paid more than 15%. Today, we're not even close to that rate. In the mid-2000s bust, we were giving away loans to people who couldn't afford them. Today, the loan requirements are significantly more restricted, and that isn't happening. Add to this that we still have a very strong labor market with relatively low unemployment. Yes, I know the stock market isn't doing so well, but this often causes people to put money into real estate, especially in an inflationary period, and especially when rental prices are as high as they are right now. If you're thinking about buying or selling, call me. I'd like to help you. In the meantime, head over to my site, take a look at the market data, grab our Raved About Buyer's Guide, or search for homes. I look forward to hearing from you.